So in today's presentation, my main focus will be to share with you some of the drivers for the second half of the year, especially in China. So I guess that you guys would be familiar. The key drivers for China right now is not on the demand side, but on the supply side. So in this presentation, we'd like to share with you our views on that. And at the same time, we also do a review on how China economy has done so far on the demand side and what can we expect in the second half of the year. And lastly, we'd also like to share with you what the overseas macroeconomy drivers are right now. Form of increase in activities given that the local government has increased their pace in the special purpose bonds issuance, and at the same time we also see that the new orders for infrastructure has also increased. But whether it can translate to the commodities that you are trading, right, it depends on what is involved, because we can actually see that whether it is fiscal expenditures or the real investment itself, right? Actually, the focus is still on resource securities, whereby a lot of the construction is related to building of the energy storage, water resources securities, or food storage. So all these are actually, I would say that more beneficial to base metal as compared to the ferrous sector.
Content side, and let's start to decode what is actually happening in the first half of the year from the economy down to the factory floor. As you already know that China's economy expanded 5.3% in the first half of this year, but the number hides a key shift in the growth dynamic. So first of all, we see the surveys, that so-called tertiary sectors again led the charge. And in growing 5.7%, overtaking the manufacturing for the first time in a year. This was driven by the trade-in subsidies, holiday spendings, and seasonal boost. And meanwhile, manufacturing, which is the secondary sector, lagged at 4.8%. On the demand side, the growth areas like EVs and solar and AI data centers are driving strong metal usage. And China's trading policies are also fueled new demands for the high efficiency applications and vehicles. And add to that low inventory level and price stability are rare commodities in today's volatile market. And of course, we can't just look at the price and volume. We also need to examine the profitabilities and utilizations. And let's take the refining as an example. Margin improved year on year this year, but not all players benefit. SOEs maintain a stable operation rate, but private refineries, those independent refiners, especially those in Shandong, were hit hard by tighter tax regulation and the fixed stock supply. And many of them saw the utilization dropped in the drop to 5-year or even 10 years low. So while headline margins may look healthy, the distribution of profit is highly uneven. So now what we have watched for the second half of the year, then let's start with the elephants in the room, US-China's tariff. And so far in year 2025, we have seen the 2 rounds of negotiation, Geneva and London, with the 3rd coming up in Sweden soon. And the recent signals like China dropping an antitrust investigation into DuPont suggest that both sides are seeking a buffer zone. And then there's a headline, Trump may visit China in September. But don't be fooled. Even if the August tariff still holds, the structural tensions around the supply chains, tech leadership, and strategy domains, all these will remain unsolved. And so if you have any tours have any interest on the tours, or you are like to dive deeper into today's themes, feel free to reach out to our teams after the session.
Thank you to our speakers for their valuable insights, and thank you all for joining us today.